Could you share with us maybe one of your recent deals that you've done and kind of some details about it? As far
Sure.
as like how you breaking that down into the, quadrants that you just had as far as acquisition, how you acquired it, where you found it, how you financed it, and then what kind of rehab you did on it and what you sold it for and that type of thing.
Sure. So would you say more people on the call would be interested in a flipping example, or more people would be interested in a buy and hold example? So I'm happy to do either.
Good question. I'd say let's let you choose because I think we probably could go half and half on it
Oh, geez.
as far as
Okay.
as far
I,
as what we have here.
I'm going to pick one person. I see Jake Pence. Raise your hand. Raise your right hand. Raise your hand now if you want a buy and hold. Okay, I'm gonna do the buy and hold. There we go. Okay.
What a good way to do it.
Okay. So I'm gonna talk about and I was on a podcast earlier today that I was gonna present this, and I ended up not presenting it on the podcast. I know a couple of you guys may have been on that podcast with Taro Yarber. So let's see, where is that screen? Here it is. Okay, can you guys see this?
Yeah.
Okay. So this was a deal that I'm in the middle of right now. So I have a partner in Georgia, Southern Georgia. He's in Atlanta, but we buy a bunch of properties in Southern Georgia. And well, if we talk about negotiating at all, my biggest tip for good negotiation and acquisition is building relationships. My biggest tip for anything you do in this business, in real estate or most businesses, is great relationships. And so this deal basically came about because of a relationship that my partner had. He had used a small bank in Georgia called Ameris Bank. I guess they're in Florida too. And he had used them for a bunch of deals, and the VP of lending called him up one day and said, I have these 3 properties in this town. Friend of mine owns them. He's sick of dealing with them. He just wants to sell them off. He's selling them, and the price is $215,000. Are you interested? Gave my partner the address. My partner looked at him. He said, wow, that's great. Yeah, we'll definitely buy that. He said, it's your friend, so I assume you trust him. You've worked with us. You trust us. Will you finance the properties for us to buy them from him? And can we do this? Can we just do this quickly and get some financing? And he said, okay, I'll get back to you. He called us the next day. He said, yeah, we'll finance them. We can finance 75% loan to cost, which means we'll take your all-in costs, your purchase, plus your renovations, plus your closing costs, and we'll finance 75% of that. And then once you get tenants in the property, we'll refi out and we'll do 75% loan to value, which means we'll do a new appraisal and we'll give you more cash out up to 75% of whatever the total value is. And we said, fantastic. So we got these 3 properties for $215,000. Now, because it was through a small bank, they had to do an appraisal. We were all confident it would appraise, but we were actually surprised. These 3 properties appraised for $305,000 as is. So it's not the renovated appraisal. That was, we could basically close on them at 215, and the appraiser thought we could put them back on the market and get 305. So we had immediate equity in these 3 properties of $90,000, which is fantastic.
Absolutely.
2 of the properties needed $10,000 in rehab. One of them needs $15,000 in rehab. And I'll talk in past and present because we're in the middle of this deal. So we're at about $35,000 in total renovation between the 3 properties. They were basically in good shape. 2 of them actually had tenants in there that were on month-to-month leases that we knew when we bought it, they were well under market, that we would either have to raise their rent or kick them out. They weren't very good tenants, so we were comfortable kicking them out. But we knew we would need about $35,000 in rehab. So our all-in costs were that $215,000 that we're buying it for. And I'm excluding closing costs here. Don't ever do that in real life, but for simplicity, I'm doing that here. Plus $35,000 in renovation. So we were all in for the purchase of at about $250, purchase plus renovation. Now, based on what the lender said, they were going to give us 75% loan to cost. That was about $187,500 or $188,000. I think we rounded up. And he gave us $188,000 in loans when we bought it, which means the day we bought it, they funded $188,000. The bank did. We came to the table with $62,000. That was our own cash. If you're doing this, lots of ways to get that cash. borrow from friends and family, bring in another partner with cash, find a private lender, negotiate better terms with the bank, take a HELOC on another property. You have to come up with that cash. Generally, when you're doing a project like this, your initial lender is going to require, if you're going to go through a bank or a hard money lender, they're generally going to require 20 or 25% down. So we had to bring $62,000. We knew renovated these properties. We talked to a great real estate agent that we work with all the time, and she basically said, once these houses are renovated and rented, you could probably sell them for $420,000 total. So our ARV, after we did that 215,000 purchase, that 35,000 renovation, those properties would be worth about $420,000. So that's the number that we haven't yet refied on this, but assuming that's the case, in about 3 months, when all the properties are renovated and rented, and we've gone through a quote unquote seasoning period with the bank, in about 3 months, they've promised that they'll be able to give us 75% of the total value of those properties as they're reappraised. We expect them to be reappraised at about $420,000. That's what our real estate agent told us. 75% of that is about $315,000. Which means we're all in for that $250,000. But since it's getting reappraised and the bank's willing to now lend $315,000, we could take all that 250 out, and we could take another 65,000 out. We could pay off our initial loan. We could get back our 62,000 out of pocket. Plus, we could get up to another $65,000 more in cash in hand after that rehab, or after that refi. Excuse me. Not saying we want to do that, and we can talk about whether you want to do that or not. But in theory, we could either take out $65,000, we could leave it in and have $65,000 in equity of the properties, or we could do some combination of those two things. Point is, we have $65,000 in equity after the refi. Our rents on this are $3,250. Let's say, and that's total, it's $1,100, and $1,050. Let's say that we wanted to take out that $65,000. Again, we probably don't want to do that, but let's say we want to take out that $65,000. We now have a loan for, or we're all in on that property for $315,000, and we're getting $3,250 a month in rents. That's basically by the 1% rule, that hits the 1% rule. So if you do the math, if you're getting 1% of rents per month, 1% of the total value of the property in rent per month, and let's say 50% of that is going away to all your expenses, that's about a 6% cash on cash return. So this deal, we could walk away with about $65,000 in our pocket, all said and done, and be getting 6% cap rate on the deal. Again, we're probably not going to take that $65,000 out. If we leave that in, I think we get closer to like 10 or 11% on the deal. And so this is a great deal for us. We're basically no cash out of our pocket. When I say 10 to 11%, we don't have any cash. So it's 10 to 11% cap rate. It's a great deal for us. We can be no cash out of pocket and be getting a 10 or 11% cap rate on this deal. And so for us, this is a home run. The other thing is, this is our cash flow, but cash flow isn't the only way to make money on a deal. So there's also tax benefits. So let's say these properties are worth $420,000. So on a $420,000, so let's say 70% of that is building value versus land value. So 420 times 0.7. So that's $294,000 on these properties in building value, and depreciation over 27 and a half years. We're getting $10,600 in depreciation every year. So there's tax benefits there too. I don't have the numbers on me, but there's also amortization. And what's amortization? It's basically just the principal pay down. So my tenants are paying my mortgage every month. Part of that mortgage is principal. So they're paying down my principal every month. So I might be getting another $3,000 or $4,000 in loan pay down, principal pay down every month from this property. And then finally, maybe appreciation, maybe not. I don't like to count on appreciation. But you may get lucky and might get appreciation from the property as well. So a deal like this, I'm basically no money out of pocket. I'm getting good cash flow. I'm getting cash tax benefits. I'm getting amortization, and I may even get appreciation. This is a home run deal for us. And it
Yeah.
all came about because we had a relation. My partner had a relationship with this lender at the bank.
Yeah, absolutely. Have you heard of people before, instead of taking the cash out, where the bank might agree to do a future, basically tie that property into maybe a down payment on a future property?
Interesting. So using the equity as collateral against a future. I haven't, but that makes perfect sense. I mean, that's one of the benefits of really building relationships
Right.
with those small local banks, because they have the ability to do what the big banks can't. The big banks have to follow the rules of the agency lenders and the Fannie Mae's and the Freddie Macs. The small banks, they can make their own rules if they know you and they trust you and they want to make an exception or do something a little bit creative. They have the leeway to do that. So I love that. Yeah.
Yeah, I guess I was just thinking about, like, you don't necessarily always want to take as much equity out as you can, but at the same time, if you have money there and you could use it to continue to grow, sometimes it could be worth it. But that's a way to maybe not take it out right now, but if you find a deal that's good in the future, you don't have to use your own cash to purchase that deal. So just a thought.
And here's the thing, if we did take the $65,000 out, basically we are still at 75% loan to value, which means we still have 25%
Right,
equity,
right.
which means the market can drop 25%, and we still aren't underwater on the property. The biggest risk with a buy and hold is simply you over leverage, and you find yourself, if the market drops and you need to refinance, you can't do it because you don't have any equity in the property. With this, I mean, we could take the 65 out, and we still have 25% equity. So the numbers work there as well.
And on that loan that you have, is that a 20-year amortization on that one, or are you doing longer than that?
Let's see. I have that somewhere.
Sorry
I will tell
for all
you.
the questions. I'm just
No, that's great. That's great.
I'm just curious. 20 years typically what I do on a lot of my buy and holds, unless if it's more expensive. I've done 30 on a few.
Let's see. I can tell you. So for that loan, maybe I can't tell you. I think it was 25-year.
Okay.
Yeah, I think, let's see. This was a Maris. That was 70. It's 20-year with 3, 5, or 7-year balloon at 4.25.
Okay. Cool. Sounds like a great deal.
Yep. Oh, I don't know if you guys saw that, what I just put up, but anyway, but yeah, it's a 20-year amortization, 5, 7-year balloon, 4.25.
And the other thing, I guess, that you didn't mention with the amortization, most people probably know this though, but every year that gets sweeter, right? So.
Absolutely. Yeah. Now, on the downside, your return on equity goes down. You have more equity,
Right.
and so there's value in that number as well to some extent. And so that's where it gets into what numbers do we care about, and that's a whole separate discussion.
Yeah. Well, so I had a bank recently tell me that they would go up to 80% loan to value and allow me to use that equity as I was paying down to purchase new properties. So say I paid down, $30,000 or $40,000 over 2 or 3 years. Well, then now you can access that. Plus you can, since I think I was at 70% on that one when we cashed it out, then I got 10% basically equity on the deal, which, it was a lot of money.
I love that. That's great. That's a bank that you want to work with a lot.
I know.
That makes life a lot easier.
For sure.
So given everything that's happened over the last few months, obviously, currently we're in the COVID pandemic. We've been in the COVID pandemic for the last 6 months or so. And a lot of people are kind of talking about a potential recession. I was just kind of curious, what do you think is going to happen over the next 12 to 18 months? Do you think we're ending into a recession? And if so, like how can we best prepare for it?
Yeah. So obviously we're in a weird time right now. There's a couple different things going on. I kind of call it the dichotomy of economies. So on the one hand, we're seeing some really horrendously bad economic indicators. GDP, 32% contraction in Q2. It's not going to be as bad in Q3, but we're still going to see contraction in Q3. We're seeing 8% unemployment right now. We're seeing millions of businesses, 1 in 6 businesses have already gone out of business, and we'll likely see millions more that go out of business. I've heard numbers like in the independent restaurant space, 60% of businesses may never recover. Things are, I mean, there's a lot of really bad stuff. Then you look at some other economic indicators, and people are saving money, and home prices are going up, and the stock market is going up, and consumer confidence, which should be a lot worse than it is. It's not great, but it's not nearly as bad as some people would expect. People are spending money too. I mean, even though savings rates gone up, people are spending money a lot faster than we expected. So it's a really weird thing. And so obviously, if you put 5 seconds of thought into it, what you realize is we have a lot of bad things that are happening, but we're mitigating those to some extent through all the stimulus. So basically, we are giving money to big businesses. Everybody knows that. We're literally handing money to big businesses. We're giving money to small businesses through PPP loans and EIDL loans. We're giving money to citizens. I mean, we're mailing out $1,200 checks a couple months ago. People that are losing their jobs are getting good unemployment benefits. In some cases, people on unemployment are making more money than they were making at their jobs. We have foreclosure. We have forbearances. So basically, lenders are saying, hey, if you can't pay your mortgage, we'll let you figure that out later. We're not going to foreclose on you. We have the eviction moratorium, where a lot of tenants are no longer at risk of getting kicked out. I'm not judging here. I'm not saying these things are good or bad. I'm just pointing out these are all the things that are right now propping up the economy. And I heard I think it's 17% of mortgages are behind. And I've heard millions of, I don't remember the exact number, but millions of tenants are behind in their payments. And so what happens? Let's imagine that we can flip a switch, and one day all of this gets shut off. Forbearances and EIDL money ends, PPP money ends, for eviction moratoriums, and we stop printing money, we stop giving out checks, we stop doing enhanced employment benefits. What happens on that day? Well, my take is that it's going to get really ugly. So obviously we're not going to do that. And when I say we, I mean the government, not me. The government's not just going to flip a switch and say, okay, we're turning everything off and everybody fend for themselves, but they're certainly going to have to move in that direction. And they may do it relatively quickly. They may do it slowly. I think it'll depend on the atmosphere after the election, who wins the election, what's going on with COVID, what's going on with the vaccine, what's going on with the economy. There are a lot of things that will impact how quickly or how slowly this transition from huge stimulus to no stimulus or very little stimulus is made. And that's ultimately going to be what drives whether we see a double dip recession, whether we see a K-shaped recession. So a lot of people are talking about, we see a K-shaped recovery, which is basically those who have a lot of money recover quickly and do well. I mean, we've seen a huge transfer of wealth in this country over the last few months, and those who are kind of lower in the socioeconomic ladder, they kind of slide down into worse situations. Some people are talking about a V-shaped recovery. Some people are talking about a U-shaped recovery. We don't know. That said, I do think that what we will end up seeing won't be worse economic numbers than what we're seeing today. I don't think the economic numbers can get worse, but I think what we're seeing in everyday life, the consumer confidence, people being able to spend money, people going to work or comfortably not going to work, I think that's gonna end. And I think we're gonna see a recession that's somewhat worse than what we see now. I think that'll probably be in the next 3, 6, 9 months. Now, the bigger question, and this is the one everybody cares about, is how does this impact real estate? And that's an even harder question. So we don't know what the recovery is going to look like, or what the next part of the recession is going to look like. And even if we did, we don't know how it's going to affect real estate. So if we go back 10 years to 2008, obviously that downturn had a massive impact on real estate. It was caused by real estate. It was caused by lending. It was caused by foundational issues in this industry. But that's not generally the case with downturns. If you go back to 2001, which was caused by the tech bubble and 9/11, housing actually wasn't hit that hard. Then you go back 10 years earlier, you go late 80s, early 90s, and that was the savings and loan crisis. And real estate actually was hit pretty hard, but that was also a bank-related downturn. And then you go back to the 80s and the 70s and the 60s, and you had a number of recessions that were pretty bad, but they didn't impact housing. And then you go back to the 30s and 40s, and you had some recessions that did impact housing. So what causes a recession to hit housing and what causes certain recessions not, we don't really know. But one of the best predictors is affordability of housing at the time of the recession. So the worse affordability is, the lower affordability is, typically the harder housing gets hit. 2008 affordability was quite low when that recession hit. Same with the late 80s, low affordability. So if you look at affordability right now, it's pretty low. Those numbers are historically low. So if that's the thing, and we don't have enough data to know for sure, but if that's the thing that's a good indicator of whether this recession hits housing hard, well, then there's a reasonable expectation that housing will get hit this time around. So basically, I am moving forward with the attitude that we're going to see a worse recession than we're seeing now. Again, not worse economic numbers, but worse kind of societal impact than we're seeing today when the stimulus stops. And I'm also working off the assumption that we're going to see a softening in the real estate market. Not necessarily 2008, not necessarily depression level softening, but I think we will see a good softening in the real estate market, and things will return to more quote unquote normal numbers.
Right. Yeah.
And I realize I basically just spoke for 15 minutes and didn't say anything. I apologize. Long story short is I don't have a crystal ball. I'm guessing as much as anybody else.
Well, I got a question to follow up with that, because, we're all guessing and we all want to be safe. And this is something that really hit me pretty hard, as far as, like, I'd never really considered this before, but I guess the question is going to involve reserves, keeping money in reserves for bad times, right? Because you look back at history, and the worst thing you want to have happen is you built this beautiful real estate business that cash flows really well or whatever, but for whatever reason, downturn happens and you can't pay all the bills. You don't have enough cash to do everything. So I started thinking about, like, okay, well, how much should I have, more so than I ever have before? And really, this made me want to up my number way higher than it's ever been before, if you know what I mean. And so my question to you is, how much in reserves do you think a buy and hold investor really needs to have to make sure they're safe no matter what happens?
It's a tough question. And I agree with you that, and I tend to be pretty risk averse.
Right.
So
You have to be.
Yeah. So let's pretend somebody owns one property, because it's certainly the equation gets more complicated as you create a portfolio.
Right.
But let's say somebody owns one property. If you look at what's the potential worst case scenario is, well, one, you need to know the eviction laws in your state. So certain states, you can kick people out very quickly and I'm talking about independent of COVID. Assume we don't have the eviction moratorium. Assume we're talking a year ago. You can kick people out very quickly. So if somebody's not paying rent, it tends to be certain states tend to be very landlord friendly states. If you live in a landlord friendly state, well, your worst case scenario is much different than somebody that is renting a house in California that tends to be very tenant friendly, and where it can take months or even literally years to get tenants out. If anybody's on BiggerPockets, one of the longest BiggerPocket threads is from a guy named Will Bernard, who is a house flipper in Southern California. And he bought a house to flip back in like 2012 or 13. And somehow there was a tenant or a squatter in there. And this thread lasted about 4 or 5 years, where he was just detailing trying to get this tenant out. And it took him literally years to get the tenant out. So if you want to talk about worst case scenario, I mean, he was not only not collecting rent, this was like a $2 or $3 million house. This was a high end flip. He was paying holding costs. He wasn't getting, so that's the worst case scenario. Now, I'm not going to suggest anybody keep enough reserves for the worst case scenario. You want to keep enough reserves for the most common case scenario. But it's important to know what the laws are in your state. So are they tenant friendly? Are they landlord friendly? That'll go a long way towards helping you figure out what your worst case scenario is. More likely scenario is that you might have a couple months of a tenant not paying. You might have a couple months of a vacancy, or you might have a couple months, or you might have a big capital expense.
Right.
And so from my perspective, those are the three things that I model. I model what's the likelihood, not even what's the likelihood, but if I were to have a tenant that didn't pay, how long is it going to take me to get them out? And let's say it's going to be 3 months. And then I have the situation where I have a vacancy. How long is that vacancy going to be? Well, let's say my worst case, I think for a vacancy is going to be 2 months. Okay. So there's that second scenario. Third scenario is the CapEx or the capital expense scenario. What's the most amount of money I'm going to have to pay for any single capital item on this house? And typically it's probably a roof. So what's the cost of paying for that roof? Let's say it's $6,000. So now I compare those three scenarios because those are the three most likely really bad scenarios to happen. You're either going to have to do an eviction and not get paid in that time. You're going to have a vacancy for a while, or you're going to have a big capital expense. Figure out what the cost of each of those three things is. Whatever that highest number is, that's your reserve for that property.
Okay. Okay.
Now, what do you do when you get your second and your third and your fourth property?
You just add them all up, right?
you don't, well, you could add them all up, but if you add them all up, you're going to have a lot of cash sitting around because the likelihood of having a worst case scenario on 2 or 3 or 10 properties at the same time. And so at that point, you have all this money that's not earning anything.
It's not doing anything.
So it's a harder equation at that point.
Right.
But then it comes down to basically what's your risk profile look like. But what I like to tell people is if you own one property, those are the three big scenarios you should look at. Whichever one's going to be the most expensive and how expensive that is, take that number and that's your reserve for that one property.
Okay, cool. Appreciate the tips.
All right. So I guess that's all the preset questions we had for now. I think what we'll go ahead and do now is open it up to Q&A. And I know Chad actually reached out to me in the private chat. He had a question for you, Jay. So I'll let you go ahead and take it away, Chad.
Hi, Jay. Thank you for joining us. It's an honor to be on the call with you.
Nice to meet you.
I actually am starting my first flip on Saturday.
Congrats.
And thank you. So excited about it. But I wanted to get your insight. There's a couple of things that are going to make it a little unique. And that number one, it's an out-of-state flip that I'm doing with my cousin who is a contractor. So I won't be very involved in terms of hands-on doing the labor. He will be doing the most of that. I've secured the financing. And so, we've agreed to a 50-50 split. But again, I don't even know what that looks like. It sounds great in theory, but is there anything that you would advise or any insight or wisdom that you would share entering into a partnership where it's 50-50? Again, he's going to do the majority of the labor and I'm going to be doing the financing.
Yep. So first, let's ignore the fact that you guys are related. It provides some additional complications, but it doesn't make anything easier and it doesn't change anything. You should be doing the same exact things. Number one, make sure you document the agreement. And when I say the agreement, what you're responsible for doing, what he's responsible for doing, and then most importantly, what happens when things go wrong? So what happens when that flip, the market turns and that flip is suddenly underwater? So who's putting in the extra money or who's taking the hit? What happens when you go over budget? What happens when you go over schedule? What happens when he decides he wants to move to Michigan and now he's no longer working on the property and he says, I'm going to bring in another contractor to work on it, but we have to pay him. What happens when you fly out there to look at the property and you see that he's doing substandard work? What happens if you list the house and he wants to sell it for a certain price and you want 30,000 more and you can't agree? These are all the things you need to talk about. and you need to document. Don't just say, yeah, we'll figure that out. We're kind of on the same page. Write down all those worst case scenarios. Find an independent person, a good real estate agent, a good attorney who can say, here's all the crazy scenarios I can think of that you might have to deal with, and figure out what you're going to do in those situations and document it. So that's number one. Because the contracts aren't written for when things go right. Contracts are written for when things go wrong. So don't put all the fun stuff in there, like, here's how we're going to split the profits, and these are the cars we're going to buy. It's the things that are going to go wrong. Number two, again, let's ignore that you're related to him. Trust but verify. So don't just, when he says, yeah, I'm going to be done in 4 weeks, don't say, okay, let's reconvene in 4 weeks. You should have somebody that you know, somebody that you trust, that can go out and look and verify that he's keeping up his end of the bargain at least weekly, maybe twice a week. Now, if you really trust him, well, maybe you can say, hey, I don't know what his name is. Hey, Greg, can you send me pictures of what you finished this week? Can you send me the receipts of all the materials that you're buying? But some level of verification, and make sure it's done at least weekly and potentially more than weekly. And then the other big thing is just figure out what your business plan is. So what are you going to do when you go to put that on the market? Are you going to stage it? Are you going to list it with a real estate agent? What are you going to list it for? How are you going to negotiate? Like, what is your bottom line number? Just figure out what the plan is, because that's something that if you're going to do multiple deals, it's hard to get that in a contract. But it needs to be talked about up front. So those are just some of the basic things, but it really all boils down to addressing all the things that can go wrong up front and what you're going to do, and making sure you have a system in place that you can verify that he's keeping up his end of the bargain. If I were talking to him, I'd be telling him to make sure you can keep up your end. He'd be doing the same thing with you.
Right.
So it's not one-sided.
Thank you, Jay.
No problem.
Great question, Chad. So any other questions we have? I'll also be checking on Facebook as well to see if we have any questions from our
So, sorry, to go off that, how are you checking on properties in 4 states? Do they just like sending you photos, FaceTime? Like, how are you, and how often are you having your quote boots on the ground?
So and this is just the way I run my business, I only do things one of 2 ways. I either have a full-time project manager, so somebody whose job it is to basically run those projects. That person gets equity or gets a profit share. So we have aligned interests. So they know the more money I make, the more money they make, the sooner that they can get something done, the faster they get their money. I'm really big on aligning interests with everybody I work with, whether it's a contractor, an employee, or a partner. So that's the first way. I actually don't have any of those anymore. We're not doing enough flip volume anymore that it makes sense to have project managers, but I've had project managers in 3 different states before. So if you're doing more than 2 or 3 deals at a time, that might make sense. What I'm doing now, and the other way that I do things, is I have partners. And typically, I will find somebody that has a very complementary set of skills and traits and things they bring to the table than I do. So maybe it's somebody that is looking for some mentorship and some help, and I'm helping them, and I'm bringing a lot of the money, or I'm bringing the credit, and then they are doing all the work. Or maybe it's we're splitting the money and we're splitting the work, or whatever relationship it is. But basically, it's an equity partner that I have. And so in Georgia, I have a partner that I've worked with for 10 years. We have a crew there that basically he manages it because he's more on site. He's within a 2-hour drive of there. And so he finds the deals, and we split the money, and he manages the crews. And then we do some stuff in Florida where I find the deals and I manage the crews, and we split the money, and it's kind of just a good working relationship. I have another partner in Maryland that we do something similar. I kind of manage the crews from afar. We split the money, but he then oversees the properties. A lot of them are buy and hold, so he'll oversee those properties. And so I love the idea of a partner. I'm one of those people that I don't mind giving up 30, 40, 50, or even 60 or 70% of my business or my profits if it means I can work less. So it's typically a lot easier to scale a business than it is to scale your time. So I'd rather be able to do 5 times as many deals in a tenth the time each deal than do more deals, or to do, I'm sorry, to do fewer deals and get more of the equity. At the end of the day, I can scale the business faster than I can scale my time.
Great. One more thing to follow up on that. So I'm assuming you at least have one LLC or company with each of those partners or states. Do you have one bookkeeper locally, or do you all handle that in-house? How do you like track all those expenses then? I know you're trusting them, but like when they have $17,000 at Lowe's or Menards, like how are you placing that? Because I'm the guy that's doing the work, I have the money partners, but I'm trying to then scale, but I'm having trouble like, does that make sense? Like compartmentalizing all that.
So across all my businesses, I have 17 LLCs, and it's because if I have, let's say I have a partnership with one person and we're 50-50 on some of our properties and 60-40 on other properties, well, we need to have two LLCs. The LLCs are going to be based on equity breakdown. And so, yeah, I have a lot of LLCs. This is the one area of my life that I will be the first to admit that I am very suboptimal, and I'm really, I'll use the word dumb. I don't like, I'm a control freak, and I don't like to hire somebody to do my accounting and my budgeting and tracking. So I actually spend about an hour a day on average doing accounting across all my businesses, all my companies, everything that I do. It's a ridiculous amount of time, but I enjoy doing it, and I sleep a whole lot better at night doing it. So if I were to tell, and my wife knows I do it, but she thinks I'm just nuts that I literally spend 50, 100 hours a year just doing just being in Excel and in QuickBooks. But I do. So I reconcile my accounts almost daily. My partners know that when they buy something, they have the credit cards. I do trust them. So they have a debit card, they have a credit card, but every time they buy something, they take a picture of the receipt. I have some systems that will file those things automatically. And I have ways that I can track schedules and budgets. I have some complicated spreadsheets with pivot tables and stuff. But the actual accounting stuff is the one part of my business that I'm very not, I've never systematized or outsourced, and I probably never will, just because it's my mentality.
That makes a lot of sense to me, man. I do all my stuff, but I struggle with the accounting side. Honestly, it's a lot of paperwork to keep up with for me. So I think everybody has their strengths too, So, but that's good. It's a good tip. So, anybody else have any other questions for Jay? Jay, man, you've been awesome tonight.
My pleasure. This was fun.
It's been awesome.
Yeah, Luke, I have a question.
Go ahead, Mike.
Well, Jay, first, before I ask the question, it's a pretty simple question, but I want to thank you. I used your book on flipping houses as a guide for my very first flip. Enjoyed it greatly.
Thank you.
And then a BiggerPockets tip was, always let people around you know what you're doing. Mm-hmm. So one of the things I did as that was winding down, I was still working at my normal job at the time. So I was letting people know, well, I just finished a house, I'm looking for another one. And it was really interesting because that first flip was a relatively simple flip, probably 15,000 rehab. Then one of my workmates came to me and said that she had a neighbor who is having trouble. He has a house that's in really bad shape and he needs to sell it. And so I ended up sitting down across the kitchen table with him using your negotiating book as a guide and ended up buying that house. That was a little bit different. If it was our first flip, we may have never done a second one because that one was 130,000 rehab and a very complicated one.
Yep.
Where we did major changes. And all that was fun, and it kind of got us at the end of it hooked. But one thing I'm finding is at this point, I'm finding that I want to do more, and we've done a few more flips, but I'm trying to get to the point where I can use my time more efficiently. I really liked what you said about segmentation into different areas. I think that was very, very helpful. But I guess the question I would have is, how do you decide where to focus on first? If you want to really streamline things and be able to scale well.
So I am a big fan of telling people to think about how much you want to make per hour. Why did you get into real estate? What is your what is your dollar per hour goal? Did you get into real estate so you can make $20 an hour? If so, great. Did you get into real estate so you can make $50 an hour? That's great too. $100 an hour, $500, $1,000 an hour. How much do you need to make? If I offered you a job coming to like work in my real estate business or working in somebody else's real estate business, basically doing all the things that you're doing in your own business right now, how much would they have to pay you for you to do that? What's your number, Mike?
That's a good question. I've not thought about it that way. I think that what I really want is to be able to achieve the same results with less hours, to have more freedom. So, yeah, I want to be able to.
So how many hours do you want? How many hours do you want to work a year?
I want to work 15 to 20 a week, whatever that works out to be.
Okay, so you want to work 800 hours a year. How much money do you want to make a year?
I want to be able to, well, at this point, I want to start building a rental portfolio. So I want to, over the next year, be able to have 8 to 10 buy and hold properties.
So is that 100,000 a year, 200,000 a year, $1 million a year?
Well, at this point, it's a matter of acquiring, $1 million worth of assets.
Okay. So let's say, so you're working 800 hours a year. So let's say you want to make $250,000 a year. You need to make $300 an hour in those 800 hours that you work, right? That's $240,000 a year.
Your math's good.
Okay. So if to hit your goal of making $300 an hour and working 800 hours a year, you should be focusing on tasks that are generating you $300 an hour. And you should not be focusing on tasks that generate less than $300 an hour. And so what generates less than $300 an hour? Well, let's see, painting your own houses. You can hire somebody for $20 an hour to do that. So don't do that. Doing your own plumbing, you can hire somebody for $50 or $100 an hour to do that. Don't do that. What are those tasks that are going to generate the $300 an hour? In my business, the tasks that generate $300 an hour are focusing on deal flow and finding deals. Nobody else can find deals for me at a reasonable rate. Number two is raising the money for those deals. Those are the two big things, finding deals and raising money for deals. Let's say my typical flip, I spend 20 hours finding the deal. And let's say I spend 20 hours raising the money, like networking with private investors or lenders or hard money people or whatever it is. I'm spending 40 hours, basically, if I'm not working in the deal, I'm spending 40 hours finding the deal and financing the deal. And let's say I have the ability to hire out everything else. Okay. And let's say typically I'm going to make $40,000 on that flip, but because I'm hiring everything else out besides finding the deal and financing the deal, I'm gonna have to give away half that money. I'm gonna have to pay a project manager, an agent, a general contractor, all these things. So now I'm making $20,000 on this deal, but all I'm doing is spending 20 hours finding the deal and 20 hours financing the deal. I'm spending 40 hours on this deal to make $20,000. I've now made $500 an hour. If I can scale that, and I just then spend the next 20 hours finding the next deal and the next 20 hours financing that deal and the next 20 hours finding that deal and then hiring everything else out, I'm making $500 an hour. Generally speaking, the two things in your business that are going to generate a few $100s an hour are going to be the finding the deals and financing the deals. Now, there are a couple other little things. Negotiating for me is a huge one. I can generate more than a few $100s an hour by negotiating. I can give me a half hour. I'm sure I can get somebody down $500. So there's a $1,000 an hour task. Quality assurance is a huge one. I mean, your reputation is everything. If you turn out a bad product, then basically you're down the tubes. So at the end of the day, to generate that $20,000, maybe you're spending 100 hours, 80 hours, 120 hours. Now you're at about $200 an hour for that project. If you can do a project in 100 hours and you can make $20,000, so figure out where your best use of that 50 or 100 hours is, hire everything else out, and now you're making $100, $200, $300, $400 an hour. So I know that was a roundabout way of doing it, but long story short, if you're figure out what your goal is. If your goal is X dollars an hour, don't do tasks or spend as little time as you can on tasks that aren't generating that dollar per hour. Hire it out instead. I can't tell you the number of people I find that they're doing their own carpentry because they want to save money, and they don't realize they're saving $25 an hour. So basically they've given themselves a $25 an hour job. And maybe they got into real estate to make $25 an hour. I didn't. So you'll never catch me doing my own carpentry.
Yeah.
I've done that many times, and I'm trying not to do that in the future.
Thanks, Jay.
I think we got time for one more, and then we'll probably wrap it up because we're a little bit over tonight right now. We want to respect everyone's time. So,
Yeah, Jay, I got a question for you.
Yeah.
So in the book on flipping houses, you mentioned that basements can be a money pit.
Yep.
One of the strategies me and my fiance were thinking about doing was to house hack and either live in the basement unit or rent out the basement unit separately. So I was just not sure why you would, what your thought process was on that.
So I meant it more from a flip perspective. Typically speaking, I find that investors tend to put way too much money into basements. Couple reasons. One, you have the appraisal issue. So space in the basement isn't going to appraise for the same as above ground space. So you can go all out and make a gorgeous basement, and you're not going to get as much credit on an appraisal as you will for above ground space. And number two is I find that too many people go in and they try and make a basement that's a little bit too taste specific. They say, oh, I'm going to put a bar down there, or I'm going to do a man cave down there, or I'm going to do something else that's going to make this basement really awesome. And what they don't realize is, yeah, they may be attracting 2 or 3% of the population who are going to say, that's the exact thing I want in my basement. But then there's going to be 97% of the population, I'm just making up numbers here, that are going to say, yeah, I don't really want a bar. I have kids, and I'd rather just have an office down there. So what I tend to say about basements is do the minimum. So put up walls to define the space, sheetrock, paint, electrical outlets, lighting fixtures, you're done, and flooring, and you're done. Let the buyer come in and use their imagination. Let them see a space that's nice and bright and open and clean and dry. And say, okay, I'm going to turn this into a man cave or an office or a studio or whatever they want to turn it into. They're happy to do that. And that's going to save you a whole lot of money. And instead I see people that just put way, way, way too much money into a basement that either makes it harder to sell the house, or they'll sell the house, but they just don't get the money out.
Thank you.
Mm-hmm. And as for whether or not to house hack, that's a personal decision, but if you're comfortable house hacking, that's a fantastic way to do it. Especially if that's a reason to build out a basement, to put plumbing down there and to put a kitchenette down there and to put a bathroom down there, if you're actually going to get income from that basement. That's a completely separate situation.
Yeah, we're moving from LA to Northern Virginia, so it's a pretty expensive market. So it's one of the strategies that we found would be useful there.
Yep.
definitely. We actually had Craig Kurlop come on the meetup a while back, and he wrote the book on house hacking. It's great. I'm house hacking a fourplex right now.
Yep.
Definitely worth it. So
I recommend that anybody who is either at that stage of their life or is comfortable doing it, it is probably the single best way to jumpstart and to build like some equity and net worth. And I wish I would have done it I wish I would have known about it a long time ago before I got married and had a wife that wouldn't let me do it.
Definitely. I've been there too. My wife let me do it temporarily, but then we started having kids. So we only did it for about 6 months, maybe 8. But man, we really appreciate it, Jay. Thanks again. I think everybody on the call would agree. I mean, tons of great information. So thank you so much.
Absolutely.
And how can people learn more about you? And do you have any events coming up or anything like that you'd like to talk about? Or
yeah. So with COVID, I'm doing a lot of podcasts and interviews these days online, but nothing to speak of. I hope people will check out our podcast. So my wife and I are co-hosts of the BiggerPockets Business Podcast. We don't talk specifically real estate, but we talk business and we talk scaling and we talk growth. And so a lot of our guests, even though they're not in the real estate field, we talk about things that real estate investors who are business owners also, if you're doing real estate, you run a business. We talk about a lot of things that you'll probably find beneficial. So check out the BiggerPockets Business Podcast. My website is jscott.com. My email is j@jscott.com. And I post a lot on Facebook, just articles and thoughts and lots of economic type articles I write. So if you want to follow me on Facebook, J Scott Investor on Facebook.
Awesome. And then we recorded this, so you guys can check this out into perpetuity. So definitely post that in the show notes as well. And yeah, just thanks again for hopping on. Hope you enjoy the rest of your day in Florida. I mean, you got a few hours light, right? What of light left?
I'm looking outside now. I probably got about another half hour.
Okay. Well, go enjoy something on the patio, I guess.
I appreciate it.
All right. See you guys.
Thanks again,
everybody.
Jay. See y'all.
Ciao.
Okay.